Ticker symbol FAST has had a pretty good 2023, returning just over 22%. And the fact is that this company has a 2% dividend yield, and it has had so for a long time. We'll be looking at a consistent dividend payer, which has a very solid balance sheet and has high cash flow consistency and great stability. So we'll be looking at Fastenal Company, an inventory management company. Fastenal specializes in providing a broad range of industrial and construction supplies by utilizing technologies such as vending devices, bin stock devices, and e-commerce. So the good thing about this business is that most of the transactions it conducts are business to business, and the main benefit from having a B2B business is that generally the transactions are more likely to be recurrent and you're more likely to have a higher retention rate for your customers. So the majority of your customers will be repeat customers and you will have more stable and more predictable revenues. Just look at what Microsoft is doing with all their services. They are able to offer a full range of products to reduce their clients' total cost of procurement. And this is really good because say they are working with a company like Ford, and Ford needs wheels, they need the doors of the cars, they need a glass for the windows. Well, they are able to provide all the different services because apart from being an inventory management company, they also provide fastenals. These are like small screws and other different small sized tools that are used in manufacturing processes. So by being able to provide a full range of products, they're able to even obtain a higher retention rate with their customers. So they have three main different segments. The first one is the Fastenal Managed Inventory, their biggest segment. Here, they help businesses manage their inventories more efficiently by allowing them to have all the information in a system, have a lot of more retention, and allowing them to need less space to store the units. Then they have the bin stock programs, which automates inventory management with tools like scales, like sensors, which alert the companies when they need to produce more of a certain good because it's almost out of stock. And finally, they have the industrial vending machines, which helps businesses monitor and control their product usage, which in turn allows them to reduce the waste and streamline their supply chain operations. They have a 32% return on capital employed. They have a 101 times interest coverage ratio, meaning that they have nothing to worry about in terms of liability in the short term. They have a pretty good cash conversion of 65%. We generally like to see this number closer to 90%, but 65% is not so bad. They have a profit margin of 44%, which is in line with what we usually look for, and the operating margin is just a bit above the margin we usually look for, which is 15%. So far, so good. It gets 4 out of 5 ticks, and the cash conversion is the one that least worries me when conducting financial analysis. Here you can see the way that their revenues, their gross profits, and their net income has been growing over time, along with their margins. There are a lot of things to note here, but we're going to stick to the most important ones. First, their margins are rock solid. They do not move a single percentage point from quarter to quarter. But another thing to note is that their revenues have a tough time growing. And when your margins are stable and your revenue has a tough time growing, all that means that your gross profit, your net income, and all the other bottom line metrics will also have a tough time growing. So this is one of the main issues I see with this company. Now, their liability condition is also rock solid. As we stated in one of the previous slides, they have nothing to worry about in the short-term debt. And as you can see here, they have more assets than total liabilities by a lot. So this is really good for their balance sheet. And they have very good debt to equity ratio, which again is amazing for the stability, predictability, and safety of investing in this company. Then their efficiency ratios, they have been doing great bits over here because the one that we like to focus on this channel, apart from return on capital employed, is the return on invested capital. And look at it, from June 2020, when it was around 29%, all the way up to December 2023, they have managed to increase this by around 8 basis points, which is incredible, especially for a company that has not been able to grow the revenues at a fast pace. Now, moving on to their dividend, you can see it is actually pretty stable. They had 4 quarters in 2020, 2021 where they actually shined, but since then you can see how steadily, predictably, and consistently they have been growing their dividend payouts. Now, in terms of yield, the yield right now makes the stock look a bit expensive since it's trading at a 2% dividend yield and the average is more or less around 2.4, 2.5%. One good thing to note here is that, as you can see, the dividend per share is increasing at a faster rate than the amount paid. What does this mean? Well, this means that they're actively buying back shares, which is another tick in the fundamentals for this company. And speaking about that, we will look at the fundamental analysis, and this company gets a solid 7 out of 8, as first of all, they have low liability risk, they have an extremely solid balance sheet, as we have seen with their liabilities, they're extremely consistent with their cash flows, they have generally the same amount of cash flow every single quarter, and as we have seen, their dividends are immaculate, and they are even conducting share buybacks, which is the icing on the cake. Then they have organic free cash flow growth, even though it's small, and the only cross I had to give them is that they are not good at growing the revenue growth organically. This is me being picky because they are outpacing inflation, which is something that a lot of investors like to see when they're investing only for the dividend of companies. And the last one, which I believe is the most important, is that they have a great moat, which gives them a competitive advantage over their peers. Why is this? Well, they have been in the industry for the longest time, and then all their customer base is extremely loyal. Since they're dealing with B2B transactions, it is very hard for their customers to actually seek for another supplier. So they have a very good moat over here, which allows them to actually have pricing power. It's not the craziest pricing power in the world because it's a very commoditized service and product that they're offering, but against their peers, this looks great. Talking about secular trends, they do follow some of them because inventory management is a huge part of supply chain management, and that has been growing in popularity over the past few years due to the different disruptions that have happened around the world, such as COVID, such as the blocking of the Suez Canal, and other factors. Now, for the growth potential, they have two main ones. The first one is attracting new clients, which, as we have seen, is very difficult right now for them. The second one would be to improve their offerings, just create a different type of service with more margin, more recurring revenue, and trying to push that to their clients. However, they have not been able to actually find the key for these two yet. This company has been trading at a premium in comparison to the earnings growth that they actually have, because a PE of close to 36 is one that I believe a fast-paced growing company should have, not a company which is growing more or less in line with inflation. And right now they are sitting at above what their historic PE ratio has been. In terms of free cash flow yield, however, they are more or less sitting a bit overvalued because their free cash flow yield is 2.5%, which is lower than the long-term inflation rate. I don't see any risk and possible challenges that concern me with this company. In terms of competitor, I only gave them 40% because they have good pricing power and competitive advantage in comparison to their peers. There are no regulations that will be coming up against supply chain, at least of my knowledge, and it would be very weird for regulations to come up against managing inventory for other companies. In terms of performance, this is the biggest risk I see, but this is all based on their ability to grow their revenues again. And in terms of market, I think inventory management is a service that you will need even if you're in an economic downturn, so this doesn't worry me at all. Before moving on, just remember I'm not a financial advisor and this is not financial advice, so please do your due diligence before actually purchasing the stock. But I do believe that this is a good company since it has a strong competitive advantage, it provides consistent, predictable, and resilient cash flows, and it has a high return on capital employed, which is great since it creates value for the investor. So I believe that this will be a great investment if revenue grows faster and they have a solid 10-year plan. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic and Trading 212.